How to legally pay less tax in the UK explained by a chartered accountant. Why do we pay so much tax, you might ask yourselves? Well, firstly, it is a legal requirement for all individuals and businesses to do so. Tax evasion is a criminal offense. And secondly, money raised through taxes is important to fund public expenditure, such as healthcare and education. Tax is by and far the largest expense most individuals will pay throughout their lifetime. However, there are a number of legal and legitimate ways you can reduce your tax bill. So let's get started. Within the UK, most individuals are awarded a personal allowance of £12,570. You do not pay any tax for any income up to this amount. Any income above this threshold is then taxed according to the income tax bands set by HMRC. One common misconception I hear is that if your salary exceeds the basic rate band, then automatically all your salary is taxed at the higher rate of 40%. This is wrong. The tax bands work in increments. As an example, a person with a salary of £65,000 would pay tax as follows. After the deduction of the individual's personal allowance, they are taxed at 20% for any income up to the threshold of £50,270, and any additional income above this amount is then taxed at the higher rate of 40%. So, if you've been offered a salary increase at work and questioning whether to take it or not due to tax, do not fear. Only the incremental income above the basic rate threshold is subject to the higher rate. It is important to note that there are scenarios where your personal allowance may be higher or lower than the standard amount. Your personal allowance may be adjusted if you have underpaid or overpaid tax in previous tax years, and it also goes down by £1 for every £2 that your income is above £100,000. And if you're lucky enough to be married, the marriage allowance allows you to transfer £1,260 of your own personal allowance to your partner, as long as one of you have an income below the personal allowance threshold of £12,570. The first way to reduce your tax bill is to make sure you're paying into a workplace pension. By not investing into your pension, you are actually losing money and missing out on significant tax savings. So what is a pension and how do they work? Simply put, a pension is a savings plan that provides individuals with a source of income during retirement. The money you pay into your pension is invested into different funds and stocks by your pension manager with the hope it grows in value, so that you can then draw upon it during retirement. You can only touch these savings once you retire. Upon retirement, you can take up to 25% of the pot of money up to the lifetime allowance as a tax-free lump sum, and the remainder is normally paid to you on a monthly basis, which attracts income tax. Every employer in the UK provides a workplace pension. The amount you pay into that pension is deducted from your gross pay before any tax deductions are made. As an example, if you have a salary of £65,000 and pay 5% of your salary into your pension, which equates to £3,250, income tax would then be charged on the net amount of £61,750 rather than £65,000. You are getting a tax saving as you pay less tax. In addition, in most cases, employers will offer to match your contributions to your pension. So really, you would have 10% in your pension fund as you would have invested 5%, and your employer would match another 5%. As an example, this is a person with the same salary with and without a pension. As you can see in this example, there is a tax saving and you are paying £3,250 into your pension fund, but then getting a tax saving of £4,246. A pension is a great and simple way to achieve tax savings whilst also setting yourself up for life in retirement. Tip 2. One of the best ways to reduce your overall tax liability is through individual savings accounts. The two main individual savings accounts in the UK are the cash individual savings accounts and stocks and shares individual savings account. Any income or capital gains earned through an individual savings account is tax-free. As an example, if you had an individual savings account with a value of £10,000 and it increased by £1,000 due to interest or capital gains to £11,000, you would not have to pay any tax for that increase in value. For the recent tax year, you are able to save and invest up to £20,000 into your individual savings account, which can be invested into one type of individual savings account or across the different types. So how do individual savings account work? Well, for a cash individual savings account, it is normally quite straightforward. The individual savings account provider, normally a bank, will provide you with interest for the money held in that account. For the stocks and shares individual savings account, your money is invested into different funds and indexes such as the FTSE or S&P, and the value of your individual savings account goes up and down based on the performance of the underlying assets. The other common individual savings accounts in the UK is the lifetime individual savings account. This individual savings account is specifically for individuals that are saving to buy their first home or want to save for retirement. You must be under 40 to open a lifetime individual savings account, and the maximum you can invest into it each year is £4,000, which contributes to your £20,000 limit. Each year, the government will give you a 25% bonus for whatever you have invested into the lifetime individual savings account, up to £1,000. The only downside is that you cannot withdraw money from this account unless you're buying your first home, age 60 or over, or terminally ill. If you withdraw money for any other reason, you will pay a withdrawal charge of 25%. Overall, individual savings accounts are a great way to save and invest tax-free. Tip 3. If you're an individual that has their own business or you run a side hustle, then creating a limited company may be the solution for you. The reason for this is that you are able to offset business allowable expenses against the income your company makes to reduce your tax bill. It is important to note that these expenses have to be directly attributable to running your business for them to be allowable for tax purposes. The types of expenses you can offset include office costs, travel costs, equipment costs, utilities, rent, capital allowances, training courses, and professional subscriptions, just to name a few. A limited company will also pay corporation tax at either 19% or 25%, depending on the level of profit made, which can be more tax efficient than an individual paying income tax. It is important to note that if you do want to extract the money out of the business to yourself as an individual, then there are additional tax implications to consider. There you have it. 3 simple tips on ways to legally pay less tax in the UK. When it comes to your tax affairs, always seek professional tax advice for your specific financial situation, as tax laws can be complex and constantly changing. If you found this video helpful, don't forget to give it a thumbs up and subscribe to our channel. And as always, thank you for watching.